Hey, thank you so much for taking time out of a busy day to join us for our 2021 Key Market Strategies interview. So, most of you guys know, attending this, that I am a humongous New England Patriots fan. And after last year, I feel like I can say that without apologizing at this point. So, I like analogies. I like breaking things down into the most simplest terms. So, sit back for a New England Patriots analogy, like it or hate it. So, if you think back to the Super Bowl against the Atlanta Falcons, now, whether you're a Patriots fan or not, I guess if you're an Atlanta Falcons fan, you wouldn't agree. But everyone would agree that was an amazing Super Bowl. Now, imagine for that Super Bowl, you had two channels to choose from. The first channel is Atlanta Falcons station, where they have panelists from Atlanta. All of them agree that the Falcons are awesome and the Patriots are awful. And all of them have different backgrounds, but on the screen it's beautifully produced. There's boxes all over the place of people having conversations about, Spygate, Deflategate, Tom Brady isn't the greatest, and whatever they might be able to talk about. Problem though is the camera's on them and on the sidelines. So you flip over to the other station, and guess what? That's a New England Patriots station. Everyone there agrees that the Patriots are awesome. Tom Brady is the greatest of all time. The Atlanta Falcons, they pump in crowd noise. All the negative stories about the drunk driving and whatever it might be. Again, wonderfully produced, but they're not talking about what's going on the field. And the entire time you missed Tom Brady's coronation as the greatest of all time, inarguably. The 25-point comeback in probably one of the most wonderful Super Bowls ever, and I think it was the only overtime Super Bowl. So this is something that you would not want to miss, but you were distracted by all the noise. So last year was very similar. We heard about stories about fake news, and you can't trust this, or this person's lying. There's all this different stuff going on. But what we missed was what was really going on in the field. So I tie this back to saying my camera on the field was a company last year called First Trust. During the pandemic, they were holding weekly phone, sometimes 3 to 5 times a week, conference calls, talking about statistics, data. Economists were talking. They were help guiding us through it. They were showing us all the real numbers and statistics, and I'm a numbers person, so it was gold to me to be able to hear these sorts of things. And they were the only real company I noticed that was having eyes in the field, cameras in the field. And it helped me keep my cool with my clients. And not just keep my cool, but help me reallocate some of my clients' money to be able to take advantage of some of the opportunities that arose last year. So no one's going to argue that the economy and the crisis was bad, but the stock market did very well last year, and certain sectors much better than others. And some of the stuff in hindsight was obvious. So with that in mind, I wanted to introduce you to First Trust. They've been around for about, I think they just had the 30-year anniversary. And they're one of my key partners, like I said. And I'm very excited that last month I heard Bob Carey on a conference call, and I talked to one of my contacts at First Trust, and I said, this stuff is amazing. I just wish I could get my clients to peek behind the curtain and hear from you guys directly. Why don't you ever open these up to clients? And I got an email the very next day saying exactly that. They said, why don't we open this up? We're happy to have you interview Bob Carey and give you the time next month. And so anyway, that's why I'm humbled, honored, and all those other great things. But in reality, he's got 30 years. He's been with First Trust for so long, and he's been one of the key people who brought them to this far. So without further ado, I want to kick it over to Scott Broman with First Trust, who's going to actually take it from here. And I'll sit back and I'll hold your questions till the end. I have the 3 most popular questions from social media, but what I will do is be checking my email. So my email is scott.nelson@lpl.com. Email me your questions, and I will make sure that I check my email throughout, and I'll ask the questions at the end. All right, enjoy.
All right, thank you, Scott. I appreciate that very much. I just want to say I'm Scott Berman. I work here at First Trust. I work with people like Scott Nelson, helping get the best investments possible for you guys. And I just wanted to introduce Bob Carey to you. He is our Chief Market Strategist here at First Trust. He has been on many different television and radio programs, both in the United States and Canada. But today he is here for you guys. So I'm not going to take up much more time. But Bob, the mic is yours.
Very good, Scott. And Scott, it's great to be with everyone here today. Thank you for the kind feedback, really, as much as anything from you, Scott Nelson. That was awfully nice to hear, and that's an analogy that we certainly appreciate. I think ultimately we've always been as much about the data and information, and we really try to distill all of it down into information that is hopefully useful and cut through the noise. We are at this point 1 day past our 30th anniversary at First Trust, and I've been here since the very, very beginning, and it's just been an incredible thing to be a part of over the years. We started off with about 35 employees at the very, very beginning back in 1991, and here we are. We've got about 900 people working for us today, with almost 200 billion in assets that we oversee. So it's really been fun to be a part of it. Our capabilities as a firm, in terms of the information that we share, as you just heard, is something we take a lot of pride in. We really don't do any direct advertising as far as the public is concerned. I think really all of our focus, really, from a sales and marketing and branding perspective, is on financial advisors. We really do believe in advice, and there's nothing quite like having that relationship with financial advisors. So what I'm going to do today, I'm going to share a couple thoughts, share a couple slides here about what we see happening in the market. We just raised our target for the end of the year the other day, and I'll explain why we did that. Obviously, we had a little bit of a sell-off today in the Dow. We've had some weakness in the NASDAQ sporadically here over the last month or two. But I think in the end, I think the market is trying to figure out a lot of different things at the same time. And in pretty much every valuation equation, valuation model that we have ever used or studied or implemented involve, pretty much the same thing. Ultimately, it's about profitability. It's about, basically inflation, interest rates, credit spreads, discount rates. Taxes are certainly part of the discussion right now. All those different things do have an impact on what happens in the marketplace from a short-term perspective. Over time, typically it's profitability that is what drives the market higher. So I've been at this now for 35 years. The Dow is about 18 times higher than it was back when I started my career in the mid-'80s. And lo and behold, if profits for all of 2021 come in as the estimates are telling us, earnings will have increased by about that much over my career. So in the end, the stock market really, as Warren Buffett says, it really is a weighing machine and not a voting machine. There's a lot of votes being held every single day, but ultimately what really matters is how the companies that make up the market are doing from a business perspective. But, we went through a lot, of course, last year, and I think it's pretty fair to say that the economy is beginning to show some signs of life. We got a report today that we've got over 8 million job openings. So it's obvious that businesses right now are constrained. They would like to hire people. Demand is there. I think our biggest problems right now, our biggest challenges from an economic perspective, are largely on the supply side. We have plenty of demand. The amount of money in circulation today is about $5 trillion more than it was a year and a half ago. And the money supply is, I think, sometimes misunderstood. But basically, we have, over time, we see this typical 5, maybe 6% increase in the money supply. And then we get to COVID, and all of a sudden, we had this massive demand for credit from businesses. If just imagine you're CFO of a company, and all of a sudden you realize that you are not going to see revenues for a period of time. You're going to do everything you can to get cash on your balance sheet. So we had significant increases in borrowing demand, and in turn, the Fed was highly accommodative. The Fed made sure there was plenty of cash made available. Now, the byproduct of that is that we have all this money in circulation. So essentially, this has been, I call it more or less a step function. We are just basically stepping up the amount of money in circulation, but we haven't necessarily increased our ability to provide products and services in the same way. And so it's going to take some time as we start to reopen the economy. It's going to take some time for the production side of the economy probably to recover. But initially, during the pandemic panic that we had back in the springtime last year, we saw just incredible amounts of money basically leaving risk assets. And we have gradually seen investors become more comfortable taking risks now than they were maybe 6 months ago or a year ago, certainly more than a year ago. And essentially what's happened is we've had more or less a round trip in the bond market. Yields for the 10-year Treasury, as you can see, went down all the way to 0.5% last August. And when you think about that 0.5% yield, that means that for every dollar that you invest in that particular marketplace, or at least get every dollar in interest that you get back, it costs you $200. So a 0.5% yield is as simply as a ratio of 200 to 1 in terms of what you pay and what you get in return. So investors paid a very, very high price for the safety of being in treasuries, and it sort of made sense in a way. We're going through something that we have essentially never gone through in modern times. And I think that as we have gotten better and better economic data in general, I think that investors are gradually realizing that they probably pay too much for that safety. And that's one reason why we've seen interest rates begin to go up. The yield curve has gotten steeper. Interest rates on our money market funds, our short-term deposits, all that stuff, those yields haven't changed, but we have seen the yield on the 10-year Treasury pick up a fair amount compared to where we were, say, 6 months ago or 8 months ago. At the same time, equities have done very, very well. Investors, for the most part, in the last 10 to 15 years, have valued equities at a more favorable rate than what we see them doing on the bond side. In other words, investors have been compensated for the risk of being in, for example, the S&P 500. The earnings yield, as you can see in this chart, is significantly higher than it is for the actual yield on the Treasury. Now, earnings yield is basically what we call the inverse of the price to earnings ratio. So if all the companies in the S&P were to pay out all of their earnings in the form of a dividend, the question is, what is the dividend, or what would the dividend yield be based upon today's price? And right now, the earnings yield on the S&P is about 4.5%. So obviously that 4.5% is better than the 1.5% that we see on the 10-year Treasury. You can see that over the last several years, these lines are starting to, more or less sync up, and so that 3% difference is pretty consistent with what we have seen over the last couple of years. And we do think that as the year goes on, the actual yield on the 10-year will go back up to right around 2% by the end of the year, maybe a little bit beyond that. And we also think that valuations, the earnings yield is actually going to go down a little bit for the S&P. And it's not going to go down because of prices going down. We think the market will do well this year, but we think that earnings will actually increase faster this year. If you look at where earnings estimates are for 2021, they stand here, and you look at where we were last year, this jump in profitability, this percentage gain in profitability is going to be faster than the actual advance in the marketplace. And when that happens, we will start to see this earnings yield begin to basically correct, if you will, the same way that the actual yield on the 10-year Treasury is correcting. Now, we are, almost at the mid-year point now. We're just a few months away from being in the middle part of the year. And I think increasingly we get to the middle of the year, the market does start to take a peek into next year. And the earnings estimates right now for 2022 imply an additional, almost 12 to 13 percentage point gain in profitability for the S&P. So basically, just take you back to December last year, and we were trying to figure out what the market was going to do this year. We had a figure of 4,200 for the S&P, and we bumped it up to 4,500 for the S&P And most of that is just simply due to the fact that these orange bars, these levels, these earnings estimates are higher now than they were 7 months ago, 7 months ago. In other words, all the analysts who cover all the companies in the S&P are telling us that companies are going to do better than they previously thought. And we had just an incredible first quarter as far as profitability. The actual earnings numbers that we got in Q1 were substantially better than the consensus earnings estimates. The gap between what the analysts thought companies were going to earn and the actual numbers, that gap essentially reached a near record level. The trend has been that in general over the last couple of quarters, earnings have been better than expected, but this was really a blowout in terms of earnings performance. And I think that's one reason why we've seen the Dow recently has scaled to new levels. And I think the market is telling us that they feel more comfortable now about the earnings outlook than we saw before. Now, we are not, basically completely out of this pandemic yet. We do have a ways to go. I live in the state of Illinois, and we are still, in many cases, shut down in some parts, especially in the city of Chicago. But I live out in the suburbs, and things are more open now than they were even a couple of months ago. I do expect that major cities like Chicago, New York, Boston, LA, and so forth, I think all of those cities that have been largely locked down are going to be much more open here as we go through the summer months. And I think that by the end of the year, I think the expectation is that this pandemic will be maybe not completely eradicated, but from an economic perspective, we are more or less going to be more or less back to doing business as usual. And I think that's going to be very good. We do have a lot of issues out there. Demand for technology, demand for materials, all these different things are at very, very high levels. And I think that in the end, we will solve some of these supply issues here as we go forward. Now, as far as the outlook outside the U.S., earnings fell last year for non-U.S. companies. As you can see, earnings got more or less cut in half for the non-U.S. Companies that make up the world stock market. But once again, you plug in earnings estimates, we're looking at a very, very sharp rebound. So a real sharp kind of V-shaped recovery as we start to peak into 2022. The earnings growth rate moderates. It's still very good, but it's more of a moderate gain for non-U.S. stocks compared to U.S. markets. And I think if the market follows this trajectory as far as profitability, I think it's pretty fair to say that non-U.S. stock markets are going to do pretty well this year. But as we start looking at start getting the next year, I think investors will probably shift maybe a little bit more of their focus back to the U.S. here as we go forward. It really has been over the last 10, 11, 12 years, you have really wanted to be in the U.S. stock market. And a lot of folks say, well, it's because of the dollar. The dollar actually is higher, certainly compared to where it was 10 years ago. But I think it goes way beyond that. The fact is, if you have a decision to make, do you want to own these companies or do you want to own these companies? I think the answer has been answered by the market. You want to own these companies because the earnings growth rate is superior. And I think that's mostly because of the much higher exposure to technology companies in the S&P. Now, I want to take just a few seconds here and talk about some themes and some sectors, if you will. I do think that the value side of the marketplace, these are companies that tend to have lower valuations. They tend to trade closer to their book value and all those different sorts of measures. I think companies, for the most part, the most important sector on the value side is financials. And I think right now financials are very favorably priced. I think the valuations are reasonable. It is the lowest valued sector in the S&P. You can see that the price to earnings ratio is quite a bit lower than the rest of the marketplace. And the fact is the earnings outlook and the trend in profitability, looking backwards but also looking ahead, as you can see, is very, very good. I want the blue, the earnings trend, to be high. I want the orange to be comparatively low. And financials are the most important sector on the value side of the marketplace. And I think we've seen that sector perform very well. Value has done reasonably well so far this year, better than growth. I also like the healthcare sector. This has been, kind of an interesting area. Here we are. We go through this pandemic, and we've certainly gotten a lot of attention paid to COVID naturally. But I think investors are aware of the fact that we have concerns about price controls and regulation, the possibility that that people have not been getting care for other ailments is a reality. In fact, we got an earnings report from a major pharmaceutical company last week, and 2 weeks ago now, and they said the reason their earnings weren't quite as good as they expected is that people are not getting treated for other illnesses the same way that they were before. I think that as we reopen, I think we're going to see people get back to maybe going to the doctor again, maybe more regularly. I think in the end, I think a lot of the health issues have been so focused on COVID that we've forgotten about other ailments. And I think that's where these companies come into play. That's where they earn a lot more money. And I think in the end, you'll see a bit of a recovery play from a profitability standpoint in the healthcare space. Once again, valuations are very reasonable. We also have inflation now that we haven't had in quite some time. A friend of mine is in the home building business, and the prices that they're paying for basic materials to build a house, 2x4s, plywoods, it could be anything related to hot water tanks, all these different things are in short supply right now. So prices are very, very high. So companies that manufacture things, companies that produce materials used for all kinds of things, they are getting very, very high prices for their products. And I think we're going to see a very strong cyclical recovery from these areas. But I think in the end, I think prices will eventually begin to come down for some of these commodities and some of these basic materials. But I think in the end, I think demand is going to stay very, very high for the next couple of years. And I think most areas of the market, I think, look reasonably priced. I think one sector that I'm cautious on right now, maybe the only one that I'm cautious on, would be something like utilities. Utility companies are really not growing their earnings. Valuations are not that bad. Most of these companies raise their dividends a little bit each year. Profits are not growing all that fast. To me, the reason to own utility stocks is to get some income. And right now, those dividend yields are comparatively attractive when you compare them to some areas in the bond market. So I do like that space from that perspective, but I don't think you're going to outperform the rest of the S&P by owning utilities. One last thing, and I shared this on my call a month ago, and I feel even more strongly now than I did even a month ago when Scott was listening in, that I really like the small cap side of the marketplace. Most of the money in the stock market over the last 5 to 10 years has gone into one style box. That's this one right here, the S&P 500 growth companies. These are big companies that are growing fast. Investors right now have the highest valuations in the stock market are in this space. That's the highest PE. The earnings numbers are there. Earnings are very good. The value companies are selling at a lower multiple, but as you can see, valuations are also consistent with lower earnings growth rate trends. So it makes sense to me why small cap or why large cap growth has been as popular as it is. A lot of big companies in the large cap tech space have got these mammoth valuations, and I think what it's done is that it has left these other areas of the market behind, especially the small cap space. Now, a lot of folks know that over time, small caps have outperformed large caps, but they do have more risk. There's a higher degree of risk. You get less technology in the small cap space, and at the same time, if investors are coming into our marketplace from overseas, which I think they have done in big numbers over the last 5 to 10 years, they tend to buy just the names that they know. The big companies, they're better known. They've sort of neglected, if you will, some of these small cap companies over here. And I think the small cap space, you get a lot of earnings growth right now. At the same time, as you can see, valuations are reasonable right now in the small cap space. So that's one area that I think is probably ignored right now. I think a lot of folks, when they sit down and they do their allocations, they probably don't have a very, very high allocation in that space. This is something we've talked about in various research reports over the last couple of years. So anyhow, with that, Scott, I'm happy to stick around and answer any questions that you might have. If there's something that I didn't talk about, I'm more than happy to answer any of those questions right now. So with that, let me turn this back over to you guys.
All right, I just figured out how to unmute myself. All right, wonderful. Thank you so much for that. I mean, this is exactly what I was looking for, and I did have a list of some questions, and you talked about quite a few of them already, but I'm maybe going to ask you to go a little bit deeper into the most popular ones. So I did a couple social media polls over the past couple of weeks getting ready for this, and the most popular question was still about COVID. I know as our country gets all these vaccines in us, and there was a major disconnect last year between the stock market and economy. And I know that you and Brian Westbury were talking a lot about COVID last year, and people are still worried whether or not the economy has any pitfalls if there's as we get through COVID. So do you see any risks in the stock market or the economy, and how would you explain the difference between the stock market performance and the economic performance last year?
Yeah, I think it's pretty fair to say that the economy is certainly performing better now than it was 6 months ago, or certainly a lot better than it was a year ago. We didn't have 8 million job openings 6 months ago or a year ago. So I think that, basically confidence has improved a fair amount at the consumer level, at the business level. I think the stock market is always looking ahead 6 months or a year, 2 years down the road. And so a lot of times the market does things and people see what's happening near term, but I think it's pretty fair to say that what the stock market is looking at is what they think that things are going to look like a year from now, 2 years from now. So the stock market, the fact that we've been hitting new highs in the Dow is telling us, look, things are going to get better. The outlook is going to improve. The stock market is very much a discounting machine, and it's not that we don't have issues out there. I think these supply-related problems that we're having are real, and I think we have injected a lot of cash into the economy. We've got government spending at a very, very high level. All these different things, in the end, are going to have to be paid for. Well, the way you have to pay for them is through an economy that is growing. So I think in the end, I think the stock market sees it, but we still have a lot of money sitting in cash. A lot of money market fund asset levels are still very, very high. A lot of folks are still playing defense. And what tends to happen in a bull market is we have this recovery in the economy, and it's not really until the end of the cycle that investors start to feel like they're missing out. And I don't think that we're there yet. I think that we're still very much in the early stages of this economic rebound. It's going to take, probably a good 6 months, a year, maybe even a year and a half before we get unemployment down to levels that were in the range of where we were before the whole slowdown. It's going to take some time. I think, when you shut down the economy, to the extent that we shut things down, it's hard to get things restarted. It takes some time, and I think in the end, the stock market is telling us that the equity markets are telling us that the economy will figure this out. We'll get our act together. I think probably the biggest risk down the road is that the Fed finds itself behind the curve. In other words, we have more inflation than the Fed has been anticipating. Investors start getting restless in the bond market. We see yields going up on the long end of the curve, and eventually the Fed starts to raise rates, and maybe they have to raise rates more than they want to. And that's typically what we see near the end of an economic cycle. And it could very well be that cycle doesn't go on for 8 to 10 years like it did the last time. Maybe it's maybe more of a 3 to 5 year kind of a cycle before the Fed is put in a position where they have to raise rates to cool the economy down and get inflation under control. So I think the bond market is giving this surge in inflation that we've been having, whether it's in oil prices or lumber, all these different things. I think the bond market is telling us that it thinks it's going to be fairly temporary. If it turns out that's not the case, that's probably the biggest risk of the market right now.
I agree completely. And one of my big takeaways from a few slides ago was when you talked about the pent-up demand in healthcare. I've been preaching the story about pent-up demand in the economy, and healthcare is not one I was considering. I was thinking about, my family wants to go to Disney World, and all these people looking to get out and back to life as normal and return whatever normal is. And you overlook the fact that so many people, there's pent-up demand in the healthcare system. So that was an amazing observation. I appreciate that.
Yeah, a good friend of mine is a doctor, and he's a anesthesiologist, and he's like he goes, we are, one of the most predictable things is just how many surgeries people get during the course of the year, and you could see he said he did 20% fewer procedures last year than he did the year before, and he's like, you worry about people not getting care, and that may be one thing that is overlooked, as you said. I mean, people, you think about the fun things about getting back to normal. I want to go to restaurants. I want to go on vacation. All those kinds of things. I want to go. I love. I'm a music guy, so I love concerts. But I think in the end, I think there's a lot of us, especially a lot of us that are baby boomers, are like, boy, we haven't probably been getting our physical things taken care of like we should be getting them, and our healthcare related things. And I think I think it's going to be a very busy summer. I think for a lot of doctors and healthcare facilities.
Hit on the next question. So I'll tell people you have a few minutes to email me at scott.nelson@lpl.com if you want to get one last question in. But the next highest question I received had to do with inflation, and you talked a little about that. My concern is what you talked about, the interest rates. So we're looking at almost a perfect storm of the potential of rising interest rates, rising inflation, and rising taxes at the same time. We're used to being able to weather one of those, and I'm not sure how we're going to be able to hedge all three of those at the same time. Any ideas on which is the most concerning to you, and any ideas to potentially hedge against it?
I think that taxes are probably headed higher at the end of the year. I do think that the fact that next year is an election year means that we probably won't see taxes changed in an election year. It's almost, you never see that happening. But I do think that the Democrats, given the fact that they control the White House, they control the House, they have the narrowest of all majorities in the Senate, I think they're going to squeak through a very, very small tax hike on dividends and capital gains. I think they feel like they need to do that. The base of the party wants to see taxes going up, especially for high income earners and investors. I think they will get a tax hike put through. It's not going to be the 40% plus capital gains rate that the Biden administration was talking about. I think that there's no way they're going to get that through the Senate. I don't think any Republican in the Senate is going to vote for a tax hike, but I think the fact that the Senate is 50-50 and we have the vice president with a tiebreaker, I think the Democrats will get a very, very small tax hike, and then I think taxes are going to be left alone for quite some time. Taxes are always changing. We never really have anything that's permanent as far as the tax code is concerned, but I think it's pretty fair to say the taxes next year are going to go up a little bit. I do think investors are pricing in those tax hikes. In fact, I think another reason why maybe the tech sector has seen a little bit of selling here lately is because people have got some pretty substantial capital gains, and if taxes are going to go up next year, if you're going to have gains, if you're thinking about taking gains, I think at the margin, I do think some investors have been perhaps selling into this strength, figuring, hey, I might as well take my tax hit now when rates are relatively low by comparison.
Do you feel like there's more risk right now in stocks or bonds? And I'll preface this by me saying that I'm similar to Westbury as being a perma bull, where I've always thought of a long-term investment as, if you think about diversification as how much of your future gains are you willing to give up for a smoother ride along the way. And I think the long-term outlook is for stocks, but in the short and medium term, with everything going on, do you feel that there are right now in this current environment more risks in stocks or bonds?
Yeah, I think for right now, given the outlook for earnings, given where we see the economy going, I think the trajectory for stocks is better, certainly better long term, but I think it's certainly better short term and medium term here as well. I just think that that yield of 1.5% roughly on the 10-year Treasury, that yield is just not going to get it done. I realize you can get better yields in other areas of the bond market, municipals, things like that. If I'm going to go into the fixed income side of the marketplace, and look, for a lot of investors, they have to have an allocation in that space. They should have an allocation in that space. I think that you're going to want to take on maybe a little bit more credit risk, and maybe not necessarily reach for low quality bonds, but I think looking for yield besides just traditional money market funds, bank CDs, things like that. I think treasuries. I think you're going to want to go a little bit further, and I think it's okay to do that right now. I think the credit outlook is improving. I think credit related issues are definitely going down. Default rates have been declining now for the last couple of quarters, and I think that will continue for the next couple of years. And I think in the end, I think you're going to want to own things, and that's really the difference between stocks and bonds. When you buy a bond, you think, well, I bought this bond. Well, effectively, what you've done is you lent your money out to somebody, and they use it to invest, or they use it to put to work in their business or whatever they do with that money. I want to own things. I want to own. I realize there's risk involved. There's certainly volatility involved, but I think in the end, the advantages of owning things and actually owning something that is benefiting from this increase in economic activity, the amount of money in circulation, all that, I think bodes well for equity investors. And it's not going to be every day or even every quarter where we see this play out. But I think over time, I think that investors are going to continue to get rewarded for that. I still see people paying a lot higher price for the safety of being in bonds compared to the price that they pay for earnings and taking on risk.
Love it, because I mean even that slide you showed earlier with the talking about the treasury yields versus the dividends in the S&P 500. I mean, you're getting paid more to own it than you are to lend to it, which is a completely different way than most people think about it. You think about bonds for income, but the earnings on the S&P 500 are significantly higher than the yield you get from investing into something secure. So, and as interest rates go up, the bonds will suffer. No one wants to hold a bond for 1.5% when there's a shiny new one for 3%, where the stocks will benefit. So anyway, that's awesome. I don't know we have much more time, but one last, a really quick question I did get just emailed to me. Someone is asking, given where the interest rates are and the risks he's talking about in bonds, would you consider the 60-40 traditional portfolio dead? I don't know if that's a quick answer, but that's a quick question to a long answer.
Yeah, not completely. I think the key is, what do you use for that 40%? And, when I started my career in the mid 80s, a lot of folks would just take that allocation. They're retired maybe, and they go right to bonds, and they could earn, 6, 7, 8%, not even think about it. I think getting income from other areas besides just straight long-term, long-duration bonds, I think makes a lot more sense. Like I said, utility stocks, there's no doubt that, pipeline-related companies, energy, LPs, things like that. There's a lot of different ways to get yield besides just simply buying bonds. I think what is in that 40% bucket is probably should be different than it was when interest rates were much higher years ago.
Great. All right. Well, I want to just say again, thank you so much for doing this for me. I'm excited to get this information out to people and give them the peek behind the curtain of the things that I'm hearing, and give them a little insight of why I'm so optimistic and why I feel like even if things get turbulent, there is good information out there where we can always find some sort of opportunity to help us get through it. Even in the difficult times last year in March, I still have notes from some of the conference calls, and I like revisiting them and seeing things. And it's almost as if you guys had a crystal ball with some of the things where things that I was hearing from you guys, we weren't hearing from the news for another couple months, whether or not it wasn't going to get enough clicks or attention. You guys were the calming voice for me and a bunch of other financial advisors. So I really do appreciate that. When I was going through those notes,
that is very, very high praise.
Yeah, and I'm saying you were one of the few companies out there really, really doing it right, and I love the fact that you guys have all the asset boxes covered so I can feel like you're being impartial. It's not like you're going to steer me towards stocks because that's all you offer. You have amazing products on all the different fronts. So if you had conviction that 10-year treasury was the right place to be, you would have no problem saying it, which makes me feel good. And for my notes I was reviewing, I remember you guys giving an example of going into the coronavirus. The stock market the U.S. economy was like a race car. The coronavirus made us pull over to the side, and while they're replacing the tires and all the other things that had to get through, we knew we had to stop for a little bit. The whole time they were injecting through the stimulus rocket fuel into this race car, and we didn't know when it was going to snap back, and no one thought it was going to snap back as fast as it did. But we did not want to be out of that race car once it was blasting off. And thank you so much for helping me keep my clients stay the course, and not just stay the course, but reallocate the course to make sure that we're in the race car with the jet fuel. So thank you so much, and I'm happy to log out and say thank you so much.